Your money feels solid until someone keeps topping off the pitcher. Think of your savings as a strong drink. Every time the central bank expands the money supply, it's like adding water, same glass, weaker mix. You paid for strength, you're left with dilution. Most people miss the shell game behind this. Governments spend, issue debt, and central banks create new reserves to absorb it. In this explainer, we'll break down quantitative easing and debt monetization in plain English, show how dilution shows up in prices and assets, give you a simple model and hard asset plan you can use today. Good day to you all, and welcome to Minted, where we cover all things finance. Today we'll be covering why your money is actually, well, worthless. Sorry to be blunt about it, but let's begin. Why fiat money is worthless without trust. Fiat money has no intrinsic value. Let me repeat that. Fiat money has no intrinsic value. It's valuable because a government says it is. You need it to pay taxes, groceries, and all that good stuff. Everyone trusts others will accept it tomorrow. That's the core. No gold backing, no commodity anchor. The system runs on trust, legal tender laws, and enforcement. Here's the thing most people miss. Value depends on scarcity. When more money is printed in a currency, that currency's purchasing power falls. That's the diluted drink. The glass didn't change. The mix did. Why does this matter for you? People who hold cash or have a high-interest savings account that yields less than inflation quietly lose wealth. It doesn't feel dramatic month to month, but over a few years, the gap compounds. You think you're safe, but your purchasing power is melting. Now, you might be thinking, I track CPI, so I'm fine. The trap is focusing on CPI Consumer Price Index alone and ignoring money supply growth, credit expansion, and asset prices. Dilution often shows up first in assets, housing, equities, collectibles, before it hits the grocery aisle. If you only watch headline inflation, you'll miss the early signal. Let me show you the shell game at a high level. The Treasury spends, then issues bonds to cover deficits. The central bank buys those bonds with newly created reserves. Banks and funds reallocate portfolios based on lower yields and fresh liquidity. Let's put it in simple terms. The government spends money it doesn't have, so it borrows some. Then the moneymakers make new money to buy those IOUs. Banks get this new money and pass it around. It looks like nothing strange is happening, but really, there is more money chasing the same amount of things, so each bit of money is worth a little less. Quantitative easing is the process by which central banks, like the Bank of England, create money to buy financial assets. Quantitative easing is sometimes known as money printing, but in reality, no hard cash is actually created, and most of us will never see it. Instead, a central bank is able to digitally create money, which is then deployed to purchase things like government debt in the form of bonds. This is what happened to the UK, to the tune of £375 billion from 2009. Quantitative easing helps lower the income investors can get from these so-called safe assets. In doing so, it makes them less attractive, encouraging the same investors to go out and put their money into riskier things in the search of better returns on their investment. One class of such assets is shares, and since quantitative easing came into the world, global stock markets have been on a healthy bull run. The theory also goes that the institutions that sell these safe bonds also put their money elsewhere, like lending to people and companies, and thus helping boost economic activity. When the economy has begun to recover, the central bank then sells its assets and sterilizes the cash it receives from the sales, so overall, no additional money remains in the system. Or at least, that's what they say. Debt monetization. So what exactly does that mean? Debt monetization occurs when a government finances its public spending by having its central bank create new money to buy government debt. This is different from simply borrowing money from private investors or raising funds through taxes. In this process, the central bank purchases government bonds using money that it creates. This action increases the total amount of money in circulation, which is known as the monetary base. Unlike typical central bank operations, which usually involve temporary buying and selling of securities to manage monetary policy, debt monetization results in a direct exchange of government debt for cash that is created from nothing. From the perspective of political economy, debt monetization allows governments to implement expansionary fiscal policies. This means they can increase spending or cut taxes without worrying about the immediate costs of interest on their debt. This can be particularly appealing during election cycles, as it enables governments to stimulate the economy and potentially boost asset prices. Additionally, it may lead to a depreciation of the currency. In practice, debt monetization is often seen as a last resort during severe economic crises. For example, During financial crashes or pandemics, governments may need to spend heavily to support the economy when borrowing options are limited. While this approach can provide short-term relief and political advantages, relying too much on it can lead to long-term economic issues and a loss of confidence in the currency. To summarize, debt monetization is the process where central banks create money to fund government debt. This allows for fiscal expansion without immediate borrowing costs, but it carries significant risks of inflation and economic distortion. It is a politically sensitive tool that sits at the intersection of fiscal policy, monetary policy, and government debt management. Let's make this real with 3 moments where things got bad in recent times. First, 2008 to 2014. The system was cracking. QE began as a backstop. The central bank bought large amounts of long-dated government bonds and mortgage securities. Yields fell across the curve, credit spreads tightened, and stocks and housing re-rated higher. The thing most people missed is simple. Consumer price inflation stayed moderate for years, so it felt like there was no dilution. But the dilution didn't vanish. It migrated. It showed up in asset markets. Housing recovered. Equities climbed as discount rates dropped. If you sat in cash, you watched asset values move away from you even while headline inflation looked tame. That's how the mix gets weaker without the glass changing size. Second, 2020 to 2021. This time, fiscal and monetary moved together. Governments sent checks, expanded benefits, and ran large deficits. Central banks expanded QE and pinned funding costs. Broad money jumped fast, while supply chains were constrained. Demand surged into fewer available goods and services. Unlike the post-2008 period, the dilution was visible in both asset prices and everyday prices. You saw swift repricing across equities, housing, and commodities, and then you saw it at the store. Cash holders lagged, real wages whipsawed. The lesson is clear. When money growth outruns real output and supply is tight, the spillover hits both the portfolio and the grocery bill. Third, the Bank of Japan and yield curve control. The central bank committed to cap certain government bond yields and buy in whatever size the market required to defend that cap. When you cap yields, you compress the compensation for holding domestic currency claims. Domestic savers face negative real returns if inflation runs above those capped yields. Pressure builds elsewhere, often in the currency and in the need for investors to seek returns abroad or in scarce assets. The pattern repeats. Policy stabilizes funding, but it pushes the adjustment into purchasing power and relative asset prices. Across all 3, the mechanism rhymes. Markets stabilize first, then dilution shows up where scarcity lives, in assets, in currency pressure, or eventually in prices. If you only watch CPI, you miss the move until it's costly. If you watch the loop, you can act earlier. Why QE exists and what it did right. Now, let's be fair to QE so we understand the full picture. The goal in crises is to prevent a deflation spiral, stabilize credit, and keep markets functioning. When funding markets freeze, healthy firms can fail for the wrong reasons. By buying longer-dated bonds and signaling easy policy, central banks reduced borrowing costs, calmed volatility, and supported employment by preventing a broader credit collapse. Think of it like a firebreak. It doesn't rebuild the forest, but it stops the flames from jumping the road. QE also bought time for fiscal and structural adjustments. Lower rates let households refinance, companies term out debt, and banks repair balance sheets. Market plumbing improved as collateral values stabilized. These are real benefits. The key takeaway is not that QE is evil or heroic. It's a tool with clear crisis benefits and clear long-run side effects. Respect both, then plan for the side effects that hit your purchasing power. So, how do you turn this into action? Use a simple selection rule: scarce, durable, useful, and costly to reproduce. Prefer assets with historic data. Gold is the core. It's a monetary hedge with global liquidity and low correlation to risky assets. It doesn't depend on anyone's promise to pay. Position sizing matters because gold has no yield. Think of it as insurance that offsets currency and policy risk. Silver adds torque. It's more volatile and tied to industrial demand, so it can move faster in inflationary or reflationary bursts. That volatility cuts both ways. Treat silver as a satellite position that complements gold's core role. Real estate adds income plus some inflation pass-through. Quality locations with sound cash flow can offset dilution through rent growth, while giving you an asset linked to real use. The downside is it's very slow. The whole process of buying a house can take 8 weeks, and if you need to sell it, it's only worth what people are willing to pay. Build the mix in layers. A core allocation across gold and real estate gives you stability and income protection. Add a smaller silver sleeve to your risk tolerance. Rebalance annually. The point isn't to predict policy, it's to own things the printing press can't conjure up overnight. So to conclude today's video, let's just say fiat runs on trust. Dilution erodes cash. Your best bet is to build defenses with scarcity. Subscribe for weekly analysis and comment what you'd like to see next. Thank you for watching, and I hope you learned something new.